Welcome to The Long Game Talking Pensions, the podcast that brings fresh insight to the challenges and opportunities in retirement planning. Major changes to UK inheritance tax rules are due to take effect from April 2027, bringing unused pension funds within the scope of inheritance tax for the first time. In this episode of The Long Game, Rachel, Meadows and Steve Berridge explore what the changes could mean for private pension savers, particularly those living overseas. They discuss common misconceptions, the long-term residence rules, potential planning opportunities, and the important role financial advisors can play in helping clients prepare. The key message: don't panic, but start planning.
Hello and welcome to The Long Game, a pension podcast for international financial advisors. I'm your host, Rachel Meadows, Managing Director at IFGL Pensions, and I'm joined by my co-host, Steve Berridge, IFGL Pensions Technical Manager. We'll be popping into your playlist periodically to talk about topical things in the world of pensions. This episode, we're talking about one of the thorniest topics in pensions at the moment, the looming change to UK inheritance tax rules. Steve, we know there's a big change to IHT rules coming in April next year, which could impact private pension savers in a big way. Could you tell us more about it?
Yeah, certainly, Rachel. So this is quite a major change in our industry. It's one of the biggest changes to the UK pensions tax regime we've seen probably in a generation, which will impact anyone with a private pension scheme. What I mean by that is it's not a public sector or occupational scheme, but like a private sector personal pension or occupational pension scheme. So this will affect people with SIPs or personal pensions or many private defined contribution occupational schemes. And by that, we mean ones where the outcome is not guaranteed. So you pay money in and the outcome is determined by how your investments perform. So the major change was announced. It was the first budget Rachel Reeves did in October 2024, when she announced that from April 2027, pension schemes would fall within the remit of inheritance tax for the first time. So what this means in practice is that the value of your unused pension pot when you retire will be added to the value of the rest of your estate. And if it exceeds the total of your unused nil rate band, or if you're in the UK, you've got a residential nil rate band, then you will pay inheritance tax on that excess. So it is quite a big change. I'll be honest with you, I'm surprised there hasn't been more outcry across the nation generally over the changes they made to the farmers' agricultural property relief. Was very controversial. We saw people like Jeremy Clarkson in London with big protests, but we haven't heard an awful lot about pensions. So I think it's creeping up on people, and that's why it's important that we sort of talk about it now so that people are ready for this change, which is not many months away now.
Right, it's fast approaching, isn't it? And I have to say, I wonder whether one of the reasons why there isn't more of an outcry is that people simply don't fully understand the changes that are coming, especially those that aren't already working with a financial advisor. And particularly, they might not understand that all of their defined contribution pensions are caught by the new rules, including things like workplace pension savings. So really quite wide ranging. It's very complicated, isn't it? And on the face of it, it doesn't sound good news for the pensions industry. It might be a flippant question, but is there still a point in having a pension from April 2027?
Yeah, I mean, absolutely. So obviously we're in the business of selling pensions, so you might expect me not to say anything different, but really we need to sort of cry from the rooftops how a pension policy is still a very viable vehicle for saving for your retirement. I mean, in terms of UK customers, of course, you benefit from very generous tax relief on your contributions going in. That's definitely something that should be promoted. If you're a high rate taxpayer, 40 or even 45% tax relief on your contributions, that still stays at the moment. And of course, the likelihood is with most people that when you come to retire, normally perhaps not on such a high tax band as you are when you're paying in. So it definitely is a net saving there. In terms of the investments, we've seen the governments over the years reducing things like the capital gains allowance, which is down to £3,000. We've seen the dividends allowance down to £500. Capital gains tax rates have gone up as well. So it's important just to stress that money held in pension funds escapes those charges. So you can build up a nice big fund, and at the end of it, if your fund has grown really nicely, you're not going to get a nasty capital gains tax bill. Compared with alternative investments, there's no chargeable gains regime to worry about. There's no income, no interest payable either on investments held. So still very tax efficient vehicle. And it's also worth making the point that if you don't hold the money in a pension, where are you going to hold it? If you hold it in an ISA, well, an ISA, when you pass away, that also comes within the regime of inheritance tax. You might think, oh, how about shares such as AIM shares? So the government will also introduce changes to that. So there's now a 20% tax charge on AIM shares. So pension still stands very well. In terms of the international market, which is obviously the market that we deal with quite predominantly, it's still important to stress that whilst perhaps the tax efficiencies on paying in contributions are not available, it's still a very good vehicle in which to save funds. The tax efficiencies on growth still remain there. And also because most people who live overseas are unlikely to have other UK assets, it's important to stress that the pension stands alone. It might have less of an impact on someone's estate than, say, for a UK customer. Most people in the UK, it's the value of their house, realistically, that tips them over into paying inheritance tax. So they've got that plus the pension to worry about. This may not be an issue for people living overseas. Yeah, 100%. Pension is still very important.
Thanks, Steve. No, it's really useful to apply the voice of reason here, isn't it? Because especially when there are big changes like this, there's lots of uncertainty. People are worried about the impact that the changes are going to have. It is important to stand back and get some perspective and ultimately refocus on what products are used for in the first place. And I think when it comes to pensions, one of the things that occurs to me is that this change, I guess, primarily refocuses pension as a vehicle back on its original intended purpose. So we've had this slightly unusual situation since pension freedoms in 2015, where pension actually is the last of the assets that you spend in retirement, perhaps because it's been held outside your estate for inheritance tax. Now, with these new changes, it probably puts your pension back primarily as your pension retirement income vehicle rather than something which you use to mitigate IHT. So, that's the first point to note. But it's also worth remembering the value that the trust wrapper has with a lot of pension schemes. I mean, particularly with our SIPs. And I know, Steve, you act as trustees across our schemes, but that trustee discretion on death around beneficiary distribution is a valuable protection. It does help safeguard customer savings. And I think in our experience, we observe that most SIP benefits are left to a spouse on death. And there is no inheritance tax between spouses. Whilst it's worth considering intergenerational wealth and planning for that, advisors will be focusing strongly on that through the conversations with their clients. The actual immediate impact on the pension might not be quite so radical as one might first imagine. So, we might have a situation where financial advisors are suggesting very romantic proposals, might we, to evade IHT?
Yeah, absolutely.
So, Steve, we all know that inheritance tax is one of the more complicated and unpopular taxes out there, but are there any common areas of misunderstanding you think are worth highlighting, or any areas where you think advisors could assist in reducing their clients' exposure to IHT on their pensions, other than the proposals point?
Yeah, I mean, you've just covered one, Rachel, to be fair, a really good one, which is about the interspousal exemption. So the first thing advisors can do is to review the expression of wishes that their clients have made to make sure they're up to date. And as you've said, in many cases, the spouse will be the correct sort of nomination, depending on obviously circumstances. So there's a big piece there. I think the decumulation end of the retirement journey will become more important as we move past April 2027, maybe more than it has been for a while, where there's always been emphasis on decumulation, sort of part of the journey, building up the fund for retirement. So definitely check those expression of wish forms to make sure that they are up to date and have the correct person nominated, because that could be really important moving forward. In terms of misunderstanding, there is actually a point that is worth bringing to the attention of the audience here about interspousal exemption, where you have someone who is, for example, a non-UK resident and are married to someone who is a UK resident, and vice versa. So where you've got the different long-term residency statuses, the maximum that can be passed across is only 325,000. It's not unlimited. It's strange, that one, in a way, because if you've got two non-UK residents, then you get the normal unlimited amount. And if you've got two UK residents, so if they're both the same, then unlimited amounts can be passed across. But it's just this difference where you've got one who's one and one who's the other. So that's an area that sometimes people are maybe not aware of, particularly international space. So definitely one that's worth bringing forward here. Another couple of items, I think probably more to do with the inheritance tax regime itself, not specific to pensions, but I know a lot of people will be aware of the way that if you give a lifetime a gift if the person dies within 7 years of the gift being made, then the gift fails in terms of inheritance tax. And there is a tapering relief system in place. And what people perhaps don't understand is that tapering relief, which starts reducing the 40% charge by 20% once you get to year 3 and beyond, only starts to take effect where the gift made has exceeded the nil rate bound. So there is actually an inheritance tax liability to be paid. So if for example, I was to make a gift of £20,000 to, say, one of my children this year, and I died, say, year 4.5, because that 20,000 is below the 325,000 nil rate band, there is no tapering effect. So if I was to pass away, it would just act to reduce that 20,000 would come off the 325,000 nil rate bound fully. That's one of those kind of areas of knowledge that even people in the financial advice space may not be fully aware of. So just one to bear in mind. Another thing that's worth bringing to the attention of our audience is the gifts from regular living, which is sort of an option that's available. It's often overlooked. So it is possible to pass on money to beneficiaries from your regular income, and it doesn't get included in the 3,000 exemption or the additional 250 gift exemption. So that's quite an important one. So you could give money from your regular income to one of your children so that it does not impact your daily sort of living standards. So if you for example had £3,000 coming in and you gave away £1,500 and you were going short on things, that would not go down well. HMRC will look at that and consider that that's not from regular living. If it's just a few £100, it's going to be fine, I'm sure. So it's just worth making that point, particularly when people get to retirement, if they might be able to sort of take small income payments from their pension and gift them, and it would be from regular living, and it would potentially escape from an IHT liability.
It's again something that advisors can work with their clients on then, isn't it? Because I suppose when they're sitting down doing cash flow forecasting, cash flow modelling with customers, it's worth just taking that into account, not just the client's income requirements, but is there any scope for setting a higher level of regular income to be able to gift?
There's one more that I just think I should mention. It's probably more relevant for the UK market, but some people think that that the house obviously is their main asset and the asset that usually provides that inheritance tax liability. So a lot of people I've heard it say, "Oh, well, I'll just give my house away to one of my children. Therefore, it falls out of my estate." Unfortunately, it doesn't work like that. So there is this concept in inheritance tax law called gifts with reservation. So if you were to gift your house to one of your children, you continue to live in that house, you would be expected to pay full market rent for staying in that house. Otherwise, I'm afraid when you pass away, that value of that house still remains within your estate, which would be a nasty surprise for your children or beneficiary. So it's one of those areas of common misconception, I'm afraid. It would be really nice if we could just sort of gift our houses away and then avoid a fine.
Always think with examples like that, they are the prime examples of why it's so important to take professional financial advice, because this is your standard man in the pub telling you what they've done, it's worked for them. Speak to a pro.
I had been in a beer garden. I've had to actually correct a couple of people on that. So it definitely is one of those.
And Steve, what about the long-term residency test? How does this link in with potential IHT liability?
Yeah, so I mean, things have got more and more complicated in recent years because the non-dom regime was replaced with effect from April 2025. This new long-term residency test, which is very impactful for IHT because it will determine whether IHT will fall on UK assets. So essentially you have to have 10 consecutive years of being a non-UK resident before you become what's called a non-long-term resident. There's also a tail as well. So somebody's moved overseas and say moved 5 years ago, for example, they might have lived abroad and they might sort of think, oh, great, I'm going to be fine. I'm going to escape any IHT liability on my UK pension. Unfortunately, that's not the case because you will still have another 5 tax years before you attain that status of non-long-term resident. So it's really important for advisors to sort of make inquiries into this area. The good news is that if you've been abroad for more than 10 years and you return to the UK, then you get 10 years again before you become a UK resident. So it kind of works both ways. But it's just important to establish, if you're looking at estate planning and you're dealing with people who've emigrated, just when did they emigrate? When did they lose that UK tax residency? And have they achieved those 10 full tax years before you start making any decisions around pension planning or estate planning in general, really?
Are there any options, thinking about the international financial advisors that are listening to this, are there any options that non-UK residents can utilise which will potentially remove their pension from the scope of IHT altogether?
Yes, there is indeed an option that's available, which we're pleased to advise our audience about today. So if you have a pension, a UK pension, and it holds, for example, a bond, that's it could be one of our bonds or the IFGL group, for example, with RL 360 or FPIL, or you've got an investment on the Arden platform. It is possible when you get to retirement that you can take an income drawdown payment, and you can take that in a form of what we call an in-specie payment. So what that means is, instead of the member receiving cash in the normal way, they would receive the value of that investment as an income payment. But what that would effectively do is remove that investment from outside the UK pension tax wrapper, and it would sit offshore. So it would become an offshore asset. So if someone had a pension and they basically wiped out with one single income drawdown payment, and they have an NT tax code, so definitely, HMRC, you consider them to be a non-UK resident, then they could remove that investment from inside the pension, standalone in their own name, sitting offshore. It's not a UK asset, so it would not come within the remit of UK inheritance tax.
Yeah, useful. So very niche. Got to be some specific circumstances in place, but there is a potential option which is viable for some clients to mitigate the impact of this. It's clear, again, as always, that we could talk about this for hours, but let's bring this to a close with a top takeaway from Steve. Steve, what is your top takeaway today?
So I think the top takeaway is that, on the face of it, this seems like a bit of a hammer blow in terms of a potential tax charge. So basically, I would say do not panic. Just start planning. Most people have got plenty of time when they come to retire to make the right decisions when they're young enough. So they've got sufficient years in hand that they can navigate through this. I mean, if you've got a pension pot of 700,000 or 800,000, for example, just taking a tax-free cash sum, for example, providing you use it correctly and don't put it somewhere else where it's liable for IHT, that on its own could reduce your pension pot underneath the threshold. So basically, don't panic. Pension's still worthwhile vehicle to use for your retirement. So don't throw the baby out of the bathwater, as the old saying goes.
I think that's going to be the key role for advisors, isn't it, in the coming months, is just trying to be that kind of calming voice of reason and sense, and just averting any panic.
And of course, in terms of the international market and advisors working that market, it's really important to not panic, and also to understand that for many people who've been abroad for a number of years, the UK pension is likely to be their only UK asset. So if they're married and both of them non-UK residents, and there's 2 lots of £325,000 nil rate bands there for a start. So you've got £650,000 in total, which is an allowance to offset against inheritance tax for any charge applies. So looking at the typical pension pot, realistically, it tends to be around the 500,000 or 600,000 mark anyway. So I would say that for an awful lot of people living abroad, this is not likely to result in any inheritance tax. I do that with a caveat that this is assuming that they've not made any gifts within the last 7 years that might have used up any nil rate band. But if they've been abroad, it seems unlikely, if they've been abroad for many years, that this will be the case. Really important. I wanted to say this on this podcast because I haven't really seen or heard anyone making this point in many of the articles I've read online so far, and it's quite an important one for the international space.
Steve, thanks so much for such an interesting pension conversation. This is a big change and it's a complex one. And it's clear, as we said just a minute ago, that uncertainty still remains. Thanks for listening, and we look forward to talking to you soon in the next episode of The Long Game, a pension podcast for international financial advisors.
Thanks for listening to The Long Game, Talking Pensions, brought to you by IFGL Pensions. If you found this episode useful, please follow or subscribe so you never miss an update. We've got plenty more insightful conversations coming your way.